Geojit Spotlight. The Reserve Bank of India is likely to hike the repo rate in the monetary policy meeting. In last two policies, the central bank has hiked the rate by a cumulative of 90 basis points in May and June due to high inflation. Dr.V.K.Vijayakumar joins us to share his views. Dr. V.K., inflation has emerged as a major challenge to equity markets globally. How do you see this challenge?
Yes, inflation is a global problem now. In the developed world, in the Western world particularly, inflation was not a problem at all for the last more than 3 decades. But now the situation has suddenly changed and inflation is emerging as a major problem. In the US, inflation in June is at 9.1% consumer price inflation. In Eurozone, it is at 8.6%. In UK, it is at 9.4%. In India, inflation is relatively lower. In June, it is at 7.01% CPI inflation, but it continues to be higher than RBI's upper band limit. Now, there are mainly 3 factors driving inflation globally. Number one, to counter the global recession of 2020 and to provide monetary stimulus for growth, all the central banks of the world, particularly the leading central banks of the world, injected a lot of money into the economy. There has been a humongous increase in liquidity. The Fed alone injected around $9 trillion into its financial system. So when more money comes into the financial system, it pushes up demand. But that alone will not lead to inflation because monetary stimulus happened after 2008 global financial crisis also, but it did not create inflation in the developed world. So there are other factors also. So what are these other factors? The second important factor is the war in Ukraine. So it suddenly triggered a rise in the price of crude oil, metals, food grains, and edible oils. So when the prices of these very important items went up, that added to inflation and aggravate the price rise. The third factor, which many people regard as a very important factor contributing to inflation, is the supply chain disruptions in China. China, unlike other countries of the world, has been following a zero COVID policy and widespread lockdowns because their vaccination is not as effective as in other countries. This is the reason why they are following a zero COVID policy. So this resulted in this lockdown, resulted in a complete disruption of the supply chains. And China is the factory of the world. And when there is supply chain disruptions, this demand-supply mismatch resulted in increase in demand without commensurating increase in supply, pushed up the prices. So these are the factors that contributed to high inflation, and central banks all over the world are tightening monetary policy, raising interest rates and tightening monetary policy to contain inflation.
How will this monetary tightening affect stock markets?
Well, monetary tightening, that is raising interest rates, will impact global growth, every country's economic growth, and also the equity markets negatively during normal times. During a boom time, expansion in monetary tightening or increase in interest rates will not impact the stock market, and it will not impact economic growth also. For instance, during 2003 and 2007, the Fed, American Central Bank, has been continuously raising interest rates. I think they raised interest rates 17 times in a row. But this did not impact economic growth negatively. It did not impact corporate earnings, and therefore did not impact the stock markets, although stock markets were steadily going up. So when central banks are tightening, when there is an economic boom, that is okay. It will not impact equity markets and economic growth. But now, central banks are tightening into a sharp economic slowdown. There are 3 major pillars for global economic growth. The first is the USA, the largest economy in the world, 25 trillion economy. Second is the Chinese economy. And the third is the Eurozone economy. All these three main pillars of growth are now experiencing a slowdown. So when the global economy is slowing down, central banks are tightening monetary policy to contain inflation. So this is the reason why stock market experts believe that this can be a little bit negative for the market, and that is why the markets corrected also. Nasdaq corrected by 34% from the peak. S&P 500 corrected 20% from the peak. In India, Nifty corrected by 18% from the peak, fearing a sharp slowdown in economic growth and a hit on corporate earnings. But now the market feeling is that the slowdown will not be as sharp as expected. There was a feeling initially that US might slip into a recession. But now the consensus, not the consensus, 50% of the economists and market experts believe that the US might go into a slowdown, perhaps a mild recession, but certainly not a very sharp recession because the economy is very strong.
Dr. V.K., how many times more will RBI raise rates and how will it impact markets?
Well, when the leading central banks of the world, particularly the Fed, is raising interest rates, RBI also will have to raise interest rates because otherwise there will be a flight of capital. When interest rates in the US are rising and India we are not raising interest rates, money will flow, particularly foreign portfolios, investors will sell more and take the money to the US markets because the US bonds are the safest asset class in the world. US treasuries are the safest asset class in the world. In the US, the Fed raised interest rates by 50 basis points, followed by 75 basis point rate hike in June, and in July, another 75 basis point rate hike. And now the market feels that there will be one more large rate hike by the Fed. So in India, the RBI raised interest rates in a surprise move by 40 basis points in May, and it was followed up with a 50 basis point rate hike in June. And in the coming policy in August, the RBI is almost certain to raise rates again. We don't know by how much. It can be 25 basis points, it can be 30, 35, or in an extreme situation, it can be 50 also, but that's a rare possibility. The RBI will have to raise rates. More than inflation management, RBI will have to raise rates to prevent a flight of capital from India to the US, right? So we can expect rate hikes, but then that is not going to be a big problem as far as the markets are concerned because this year, the coming year, 2022-23, financial year 23, India will be the fastest growing large economy in the world. Global growth will be down to 3.2% this year and 2.9% next year. These are the IMF's projections. But whether it is IMF or World Bank or the RBI or Indian government, the projection of India's growth rate above 7% will be the best growth rate among the large economies of the world this year and the next year also. So India's corporate earnings will be reasonably good, and that bodes well for the Indian equity markets.
Thank you, Dr. V.K.